All right, let's talk about Li Auto's latest earnings call. On the surface, it looked like a pretty rough quarter, but underneath, there's a massive strategic pivot going on. The market's reaction? Well, it was a total paradox, and we're going to figure out exactly why. Let's get into it. So get this, on August 28th, right after their earnings call, Li Auto stock, which was actually down in the pre-market, suddenly flipped and rallied, closing the day up almost 3%.
And here is the paradox, the real head-scratcher. This rally happened even though the company missed on earnings and gave a pretty weak outlook for the next quarter. So what in the world did investors see that the big, splashy headline numbers didn't show? That's what we're here to break down.
Okay, so first things first, let's unpack the numbers that created all this confusion in the first place. It was, no sugarcoating it, a clear miss on both fronts. Non-GAAP earnings per share came in at 19 cents, falling short of the consensus, which was around 24 cents. And revenue? Same story. It came in at $4.24 billion, but analysts were looking for something closer to $4.46 billion. So yeah, not exactly a stellar report card, right? Now, if you dig into that revenue number, you see a really interesting story. Compared to the same time last year, revenue was down 4.5%. And that's a direct result of the absolutely brutal price war that's happening in the Chinese EV market right now. But if you compare it to just the last quarter, revenue was actually up almost 17%. So we're seeing some signs of life, some recovery there.
So, weak numbers on the top and bottom lines. Why the rally? What gives? Well, it's because the market looked right past those misses and saw something else entirely, a story of incredible financial resilience in a really, really tough environment.
You know, this quote from the CFO, Johnny Tai, on the earnings call, it pretty much sums up the whole thing. In the middle of a price war that is just crushing some of their competitors, management's entire focus was on one thing, controlling costs and protecting that bottom line. And you know what? They nailed it.
And here's the proof. I mean, look at this. Despite selling their cars for less money, their gross margin held strong at over 20%, with vehicle margins right behind it at nearly 19.5%. For an EV maker in today's cutthroat market, that kind of discipline, well, that's exactly what gets Wall Street to sit up and pay attention.
And this number, wow, this is their superpower. The company is sitting on a cash pile of about $15 billion US. That is a war chest. It lets them not only weather the price war, but more importantly, it lets them fund their incredibly ambitious future.
But here's the thing. Investors weren't just buying resilience. They were buying a massive, company-altering strategic pivot. This is a bet that Li Auto can transform itself from a company known for its hybrids into a true leader in pure battery electric vehicles, or BEVs, and AI.
And this isn't some far-off dream they're talking about for 5 years from now. No, this pivot is happening right now. Deliveries of their very first pure BEV, the i8, literally just started in August. They're aiming to have over 8,000 of them on the road by the end of September. And hot on its heels, the i6 BEV is launching at the end of this month. This is an aggressive, fast and furious rollout.
You see, to make this whole thing work, they're not just building cars, they're building a tech moat around them. They've rolled out their own advanced AI driver assist system. They have their own in-house chip that's already being tested for a 2026 deployment. And they are aggressively building out their own charging network. This is the whole shebang, full-stack vertical integration.
And if you thought that was ambitious, get a load of this. The CEO's Chong Li came out on the call and said they believe they can achieve level 4 autonomous driving, that's full self-driving in most situations, by 2027. That is a very, very bold claim.
Okay, so this huge pivot sounds amazing, right? Well, it comes with a price. And that price is some serious near-term pain, which was reflected loud and clear in the company's cautious guidance for the next quarter.
And when I say pain, yeah, the guidance for Q3 looks pretty rough. They're projecting a nearly 40% drop year over year in both deliveries and revenue. That's a huge contraction.
So how does management explain this? Well, they're calling it a digestion phase. Basically, it's a fancy way of saying, hey, we're in the middle of a massive construction project, and things are going to get messy for a bit while we absorb the launch costs and completely reset our sales teams for a new product.
But, and this is a huge but, there's that theme of resilience again. Even with sales expected to plummet, they told investors they expect to maintain a gross margin of around 19%. This was a critical signal to the market that, hey, our operational discipline isn't going anywhere, even during this messy transition.
So you've got a tough present versus a potentially transformative future. Let's weigh the risks, put it all together, and get to our verdict.
The question for any investor looking at this stock right now is pretty simple. Do you bet on the painful transition, or do you bet on that long-term vision?
Our call here at Talk Tickers is a firm market perform, and that rating really reflects a very delicate balance. Look, the long-term potential here, if they pull off this BEV and AI pivot, is absolutely enormous. But the near-term execution risk is also incredibly high, especially in this hyper-competitive market.
Now, for our investment committee's little wild but plausible trade idea. Given all this uncertainty, the play isn't to bet on a specific direction, but to bet on pure volatility. A long straddle, which is just buying both a call and a put option for November or December, could pay off on a big price swing. Whether the i6 launch is a massive success or a total flop, the stock is probably going to move big, and that's exactly what this trade is designed to capture.
So to wrap this all up, Li Auto's Q2 was a classic case of looking way past the headlines. The miss was real, but it was completely overshadowed by that impressive margin resilience. The real story here is a high-stakes, company-defining pivot to BEVs and AI, and it means we're looking at a challenging transitional quarter ahead as they navigate it all.
All of this leaves investors with one critical question. Can Li Auto's incredible operational discipline survive its own massive ambition? And as always, a final reminder, this is not financial advice and is for informational purposes only.